Hi everyone, welcome to Market Grow Money. I'm Sashi. Today we are going to see about an important concept in trading called average, which will be very useful when you entered with a proper strategy or plan. The same concept can turn against you if used it without any plan. The name of this magical concept is called averaging into your trade position, or simply we can call averaging trades. Let's see what is averaging in the stock market. There are multiple kinds of averaging strategies a trader can use in a variety of market settings. Average into a trade position is a simple concept in trading in which we will trade additional quantities of the same asset class to median the trading price. For example, if we buy 10 shares of Tesla at $800 per share, then after 1 week the price falls to $700 per share. Again, we tend to buy 10 more shares at $700. This time the price falls again to $600 per share. Now, as a third time, as we like to average, buying 10 shares at $600, now we have 30 shares of Tesla with a median. That is break even price 700 per share. There is a high probability that the price can bounce above $700 and we may close our trade in a profitable way. Always don't do quick average. Do average only at the fixed percentage of up or down in the asset class. I personally prefer average only when 15 to 20 percentage fall in the asset class. So if we average couple of times, then the asset price nearly falls up to 30 to 40 percentage from its initial market price. There is a high chance for a fundamentally strong asset to bounce its price after a heavy fall. I hope you understand the average concept. Here is an introduction to the different ways you can average your stocks. There is three major types of averaging trade. Number 1, averaging down. A trader or investor, when purchasing additional shares of a previously initiated investment after the price has dropped. The result of this second purchase is a decrease in the average price at which the investor purchased the stock. Trading more shares means the average cost of all shares held is lower, and this leads to the break-even point lowering as well. This averaging method is suitable when the market sentiment is unstable. To compute for the average price of the new stocks you just bought, you have to compute for the total costs including its charges and divide it by the total number of shares bought. In simple terms, when you buy a stock and it goes down, then you buy more at a lower price, that is averaging down. This works very well with the stocks that you want to hold on for the long term. Example, here is a scenario for your better understanding. If you have $6,000 as investment capital, but market trend is unpredictable, then you may opt for the strategy as follows. First, you would buy Apple stock for an example of 20 quantity at the price of $100 per share. Your total investment value was $2,000, then remaining you would have $4,000. The stock tanked all the way down to $80 per share in the next 6 months. In this stage, we do our first average for $2,000, that is coming around 25 shares. Remaining we have $2,000 left. Break even point at $88.88 per share. Further, the price falls to $60 per share. Now we do our second average for $2,000 again. We get 33 shares. Remaining balance we have $0. Break even point at $76.9. Actually, we are traveling against the trend, but you tried to average down and begin to get back in the green sooner. But there is this strong belief that a fundamentally strong stock will bounce again. So once the stock price comes above $76.9, we will enter in a profitable trade zone. So averaging down is a good strategy when used for well-known large companies, especially ones with free cash flow. Chances are they will have stock buyback programs and be actively aggressively purchasing shares to help the shares climb back as well. Make sure that a risk of averaging down is you can easily buy way more of a stock than you actually wanted, so it can also make sense to return shares after your stock recovers. Second one is averaging up. We saw about averaging down before. It means buying more when the share price is down. Similarly, averaging up means buying more when the stock price has gone up. Averaging up is a widely used strategy when the market is in strong trend. Using this strategy, traders trade new units if they are assured of that the original trend of the stock is intact with significant growth potential. Traders should be very careful when doing this method. Let's get clear with an example. If we have $6,000 as investment capital, also market trend is very strong and you able to predict clearly, then we needed to build the strategy as follows. Make an initial buy trade of 20 quantity at some company at the price of $100 per share. Your investment value would be $2,000. Remaining, we have $4,000. Then, sometime later, if price raises to $120 per share, now we do our first average of $2,000. That is, we get 16 shares. Remaining balance would be like $2,000. Break even point at $111.11 per share. However, soon after your purchase, the stock tumbled to $140 per share. Here, we do our second slot of average for $2,000. That would come around like 14 shares. In that way, remaining balance will be $0 and the break-even point at $120. The belief behind this strategy is traveling with the trend. So if there is a strong trend present in the market, then the trader can end up with good profit amount. I'm still trying to make a move from being a trader to an investor sometimes. As a trader, I felt always skeptical about averaging down. But for an investor, the average down may work out well if he finds some good value when the price falls. So always keep in mind that one can always use the profits of the other stock to book losses from a wrong stock. So the next concept we see is pyramiding. So how do you do pyramid trade? Pyramiding is an aggressive trading strategy that involves compounding one's existing positions as the share price moves in a desirable direction. It can literally double or even triple your profits on a single trade, but if used it in an improper way, it can be damaging. In other words, strategically buying or selling in order to add to an existing position after the market makes an extended move in the intended direction. It classifies as an averaging strategy due to the nature of growing the average price by putting in fresh positions into a trade where they expect bullish growth. It is suitable for those who can manage high risk situations. When you are right, you need to be really right, and when you are wrong, you need to be little wrong. This has to be your mentality if you ever wish to become a consistently profitable trader. Pyramiding concept fits perfectly into this type of mentality because it compounds your winning trades into twice or thrice times your initial profit potential while reducing your overall exposure. Therein lies the best part about pyramid trading. If done properly, you won't be taking any additional risk. In fact, you are actually mitigating your risk as the trade moves in your favorable way. Mostly, my advice for retail trader to avoid this strategy, as this strategy will consume more of your money at every step of average. If we have $3,500 as investment capital and if we have proper risk management and clear vision about the stock or currency pair, then we needed to build this strategy as follows. Like, make an initial buy trade of 5 quantity at some company XYZ At the price of hundreds dollars per share, investment value would be $500. Remaining balance we have $3,000. Then later if the price falls to $80 per share, now we do our first average for $1,000. We get like 20 shares. So remaining we have $2,000. Break even point is at $88.23 per share. So further the price falls to again $60 per share. Now we do our second slot of average for $2,000. That is, we get 33 shares. Remaining balance we have 0. Break even point at $70. You can clearly see that you get to double your invested money at every step of average, step by step. So this is where the real magic happens. Notice how the profit potential for each additional position is compounded throughout the trade, while the risk is continually mitigated. The example above shows a market that's in a clear uptrend, making higher highs and higher lows like a stair-step pattern, where the market is continually breaking its resistance and then transform that resistance as new support. Market conditions were ideal for scaling into a winning trade. The initial buy order in the scenario above is triggered when the market retests its former resistance as new support. The second and third buy orders are similar to the first, which are both triggered when the market retests a former resistance level as its new support. Remember that the market has to break through each level and then have to show signs of holding in order to justify adding to the original position. This is why having a strong trend in place is a requirement for performing effective pyramiding concept. To do this strategy, we needed more capital amount than usual, almost like an institutional traders. Let's see advantage of average concept. It is a simple and easy method used to get avoided from making loss when the market trend is unpredictable. Personally, I use average method when the market goes extremely in high price, like in this pandemic period. Pyramiding is best for institutional traders with unlimited capital and who has a clear plan. Let's see its disadvantages. For most of the traders who doesn't usually enters with a proper plan, average is like a money trap. If the traders use this average method in poor fundamental assets, which results in making huge loss, causing damage to their capital. Pyramiding is worst option for retail traders with limited invest capital, also when entered with an improper plan. Doing more frequent average without a fixed percentage of down or up in the asset class can cause damage to the trader's capital. Knowing when to use averaging takes a great deal of practice. Keep things simple by using the same position size for each block of buying or selling. Maintain a proper risk to reward ratio at all the times. Define your support and resistance levels before entering the trade. Like plan your trade and then trade with your plan. So avoid greediness. It's too easy to fall into a trap of thinking that the market isn't going to take reverse on you. But remember, markets ebb and flow. Even the strongest trends experience pullbacks to the mean. So always stick with a plan no matter what, and also have an exit plan too. I hope this video is useful to you. Kindly subscribe to my channel for more useful videos. Feel free to comment below if you have any queries. Thank you.